You probably pulled out a piece of plastic today. Or maybe you didn't even do that. Maybe you just tapped your phone, half asleep, barely looking at the screen. Either way, somewhere behind that transaction, in less time than it took you to grab your coffee, a three-digit number was already doing its job, deciding instantly whether you're the kind of person a bank can trust. Here's the part that should stop you for a second. That number is younger than the Sony Walkman. Younger than the microwave sitting in most American kitchens. Younger, honestly, than a lot of your relatives. The first standardized version of it, the thing every lender in the country agreed to actually use, didn't exist until 1989. Sit with that. No FICO score. No neat 300 to 850 scale glowing quietly in an app on your phone. No credit monitoring notification. No, your score just went up 4 points. None of it. So how exactly did a bank in 1960 decide who got a mortgage? How did a bank in 1920 decide? Or 1870, back before the country even had anything resembling a nationwide banking system? Was it fairer than what we've got now? Was it worse? And this is the question that actually matters. Who got left out? And why? Because before 1989, there were merchant spies writing secret reports on your neighbors. Actual networks of paid informants, filing notes on strangers' reputations. There were department store clerks silently docking you points behind the counter for a late payment you didn't even know they'd noticed. There were federal maps, actual government maps, that colored entire neighborhoods red and quietly wrote off everyone living inside them. There were files, thick and permanent, and completely unaccountable that could note your race, your drinking habits, who you were seen with on a Saturday night, and you would never, ever be allowed to read a single word of it. There were women who, legally, could not open a credit card in their own name without a husband's signature backing them up. And there was a mathematician nobody in banking wanted to listen to for almost 30 straight years, because his idea threatened to make an entire profession obsolete. This is the story of how American lending crawled its way from whispered reputation to a single standardized number. And, maybe more importantly, it's the story of whether that trade actually made things fairer, or just made the old biases a little harder to see. And honestly, once you start pulling on this thread, it goes back further than most people expect, almost a century and a half further than the number sitting quietly in your banking app right now. Let's go back, all the way back to 1841. New York City, in the middle of a brutal financial panic that had just wiped out hundreds of merchants almost overnight. Businesses collapsing in weeks. Trust, real, personal trust between people doing business with each other, evaporating just as fast. A businessman named Lewis Tappan looked at that wreckage and asked a very practical, very uncomfortable question. How is anyone supposed to know who's actually safe to lend money to? Because at the time, the honest answer was, you didn't. Not really. You asked around. You wrote a letter to somebody who knew somebody. Mostly, you relied on your gut. And your gut was fed almost entirely by gossip. Tappan's answer to that problem was something called the mercantile agency, widely considered the first organized credit reporting operation in the country. The idea, when you strip it down, was almost embarrassingly simple. Instead of every single merchant separately guessing about a stranger's reliability, a network of local correspondents, lawyers, shopkeepers, whoever happened to have eyes on the ground in a given town, would report back on the reputation of local businessmen. Were they reliable? Did they pay what they owed? Did they drink too much? Gamble? Keep the wrong company? And here's the detail that tells you everything about what this system actually was. The question correspondents were instructed to answer wasn't, "Can this person do arithmetic?" or "Does this person own anything of value?" It was something much closer to, Is he a man of fair character and good business habits? Character, not collateral, not income. Character, as judged by a stranger you'd never meet, based on rumor, filtered through his own mood that week, and then passed along as if it were simple fact. If that sounds informal, that's because it was. There was no standardized form, no numeric scale, nothing resembling due process. A correspondent's private opinion of you, shaped by his own biases, his own prejudices, maybe just his own bad morning, could become the permanent record that a merchant 3 states away relied on to decide whether you deserved credit at all. And here's the thing that should genuinely surprise you. It worked, commercially at least. It worked well enough that it didn't stay small for long, not even close. By the 1870s, the operation that grew out of Tappan's idea, eventually run by a man named Robert Dunn, and later merged into what we now know as Dun and Bradstreet, had swelled into a network of more than 10,000 correspondents scattered across the entire country. 10,000 people, each one essentially freelance, each one filing subjective personal judgments about their neighbors into a growing centralized ledger that merchants everywhere would pay good money to access. Subscribers would flip through thick reference volumes, printed in tiny code so a rival couldn't casually read over your shoulder, looking up a stranger's name before deciding whether to extend him credit. Think about what that actually means in practice. A shopkeeper in Ohio could pull a report on a businessman in Georgia he had never met, never spoken to, never laid eyes on, based entirely on what one correspondent, who might have a grudge, might have a prejudice, might just have been flatly wrong, decided to scribble down about him. There was no mechanism to correct false information. None. There wasn't even a mechanism to see what had been written about you in the first place. And because these reports leaned so heavily on vague ideas like character, the whole system became a nearly perfect vehicle for exactly the kind of bias you'd expect out of 19th century America. Reports could, and did, reflect race, religion, and social standing just as much as anything resembling actual financial behavior. This is worth sitting with for a second, because it's a pattern you're going to see again and again as this story unfolds. Every single time a new credit system showed up claiming to replace old-fashioned bias with something more objective, it mostly just moved the bias somewhere a little less visible. And notice how much money was riding on all of this. Access to those reference books wasn't free. Merchants paid a subscription fee for the privilege of looking a stranger's reputation up in code, and the agency had every commercial incentive to keep expanding its coverage, city by city, regardless of how thin or how biased any individual entry actually was. Accuracy was never really the product being sold here. Coverage was. The more names in the book, the more subscribers willing to pay for access to it. But here's the limit of this early system. It was still built for merchants judging other merchants. Businessman to businessman. What happened once credit stopped being about businesses altogether and started being about ordinary people just trying to buy a couch? Fast forward into the early 1900s, and then push on into the 1920s, when something enormous shifts in ordinary American life: installment buying. Suddenly, you don't need to save up for a stove, or a sewing machine, or eventually a car. You can just pay a little each month. Mass retail is exploding across the country. Department stores are popping up in every mid-sized American city. And for the first time in a big way, ordinary working people, not merchants, not businessmen, just regular families, want in on credit too. They want to buy a dress, a stove, a full set of furniture, and pay it off slowly, over months, sometimes years. Stores needed a fast way to decide who was actually good for it. And what they came up with was blunt. manual, entirely internal to that one building. A point system. Picture a credit clerk sitting behind the front desk of a department store with a ledger open in front of him. Pay your account on time this month? Add a couple of points. Miss a payment? Lose several. Right off the top. File for bankruptcy or default outright. You're essentially finished. Dropped straight to the bottom. No appeal. Add it all up over time, and a customer got sorted into a letter grade. An A, AB, AC. And that grade decided exactly what you could buy on credit, and how much of it. There was no science here. None. There was a clerk, a pencil, and a running tally that lived entirely inside that one store's private files, in a drawer somewhere behind the counter. Walk across town to a different store, and you started over completely from zero, because nobody was sharing that ledger with anybody else. Your reputation as a borrower didn't travel with you. It stayed locked inside whichever building you happened to be standing in that afternoon. And if the clerk simply didn't like you, if he'd heard something, anything, about your family, or just didn't trust the look of you standing there, there was no separate authority anywhere to check his math, no appeals board. His judgment was the system, full stop. Now imagine you're a young mother in, say, 1925, trying to furnish a home on a tight budget. You've paid off a set of curtains on time at one store across town. Perfect record. Not a single missed payment. It doesn't matter one bit at the store down the street. You walk in a stranger. You start again from an empty column, and the clerk behind that particular counter decides, on the spot, whether your face and your manner of speaking earn you a decent grade or a bad one. Local grading like this could only stretch so far, though. Soon enough, one company decided it wanted something far bigger than a single store's private ledger. It wanted to know everything about everyone, everywhere, all at once. In 1899, in Atlanta, a company called the Retail Credit Company got its start. Decades later, it would rename itself into something you've almost certainly heard of, Equifax, in 1975. But before it became a household name synonymous with your credit report, the Retail Credit Company built something genuinely unnerving. Its files didn't stop at payment history, not even close. They stretched into political affiliations, personal rumors, drinking habits, who you lived with, and how. Field investigators, actual people, sent out to knock on doors and ask your neighbors questions about you, would jot down whatever they felt was worth noting, and none of it needed to be true, relevant, or remotely fair to end up sitting permanently in your file. A nosy neighbor's offhand comment, a rumor about your marriage, an investigator's own snap judgment about your appearance or your tone of voice. All of it went in the same file as your actual payment history, weighted no differently at all. And here's the part that should actually shock you. For most of the 20th century, this was completely, entirely legal. Credit reporting was almost totally unregulated until the 1960s. There was no federal law requiring these companies to show you your own file. No law requiring them to let you dispute something false sitting inside it. No law stopping them from recording your sexual orientation, your race, or a neighbor's petty grudge against you, and then quietly letting that shape whether you could ever buy a house. You could be turned down for a loan because of something written about you that you were never allowed to see. By an investigator you never got to question, based on standards that nobody, anywhere, ever had to justify to you. And the company didn't stop at lending either. Over the following decades, it expanded into investigating people for insurance, underwriters and employers too. The same kind of file, the same kind of unverified personal detail, just handed to a different customer with a different reason for wanting to know everything about you. One company, one growing archive, deciding who counted as low risk across huge parts of American life, with no outside party ever checking its work. And if you think that kind of judgment stayed confined to private files sitting in some company's cabinet, it didn't. The federal government got in on it too. Officially. On paper. In the 1930s, in the middle of the Great Depression, the government created the Homeowners Loan Corporation to help keep struggling families in their houses. As part of that effort, HOLC drew up something called residential security maps for cities across the country. Maps that color-coded neighborhoods by how risky they supposedly were for lending. Green meant best, blue, still desirable, yellow, declining, and red. Red meant hazardous. Stay away. The people drawing these maps weren't shy about their reasoning either. The written notes attached to individual neighborhoods openly discussed the racial makeup of the people living there as a factor in the grade. Not as an afterthought, but as part of the explicit case for why a neighborhood deserved a hazardous label. Here's the part that turns this from a bureaucratic footnote into something much darker. Those color codes tracked race almost as closely as they tracked anything about the actual condition of the housing. Predominantly, black neighborhoods got marked red again and again, regardless of the quality of the homes or the reliability of the people living in them. The Federal Housing Administration, created around the same time, ran its own version of this practice, quietly steering mortgage insurance away from those same communities. This is where the word redlining comes from, literally, from the ink on these maps. And unlike a department store's private ledger, this wasn't one clerk's private prejudice. This was federal policy, shaping who could get a mortgage, in which neighborhood, for decades, a practice that continued in one form or another into the late 1960s. Picture two families, same income, same solid payment history, applying around the same time in the same city. One lives 3 blocks inside a line marked green on a government map. The other lives 3 blocks on the other side of that same line, in a neighborhood marked red. Same financial behavior. Completely different outcome, not because of anything either family did, but because of where a map maker, working off assumptions about race as much as risk, happened to draw a border decades earlier. No amount of on-time payments could ever fix that. The number that mattered here wasn't attached to the person at all. It was attached to the street. So picture the scale of what all of this adds up to. A century of privately run character reports. A rumor mill masquerading as a credit bureau. Store ledgers with zero oversight. And, running underneath all of it, an actual government map deciding entire neighborhoods weren't worth lending to at all. While all of this kept quietly compounding, with almost zero accountability anywhere in the system, something very different was starting to take shape on the other side of the country. An idea that 2 men in California were convinced could replace all of this rumor-based, map-based judgment with actual, verifiable math. Banks, as it turned out, were not remotely ready to listen. Not yet. Meet Bill Fair, an engineer, and Earl Isaac, a mathematician. The two had worked together at the Stanford Research Institute, and somewhere in the middle of their conversations, they landed on an idea that sounds almost too obvious once you say it out loud. What if you could actually predict whether someone would repay a loan using real data, instead of a stranger's gut feeling about their character or a color on a map? In 1956, they founded Fair, Isaac and Company, out of a small office in San Rafael, California. Not a bank, not a credit bureau. Just 2 guys with a theory, a stack of numbers, and the enormous task of convincing an entire industry to fundamentally change how it thought. It took them nearly 3 years just to make their first sale. Fair and Isaac wrote letters to around 50 of the biggest lenders and finance companies in the country, laying out their pitch and asking for a meeting. Out of 50 letters, exactly one company wrote back: American Investment Company, a consumer finance lender with hundreds of small local offices scattered across rural America. In 1958, American Investment became the first company in the world to actually run its lending decisions through a statistical scorecard instead of a loan officer's gut. Building that first scorecard was brutal, unglamorous work. There was no clean database to pull from. Fair Isaac's own people had to physically travel to American Investment's branch offices, sit in back rooms, and copy information by hand off old paper ledger cards, thousands of them, before any of it could even be turned into something a computer could process. It took over a decade after that before Fair Isaac landed its first actual bank as a client in 1970. Banks, it turned out, were even more resistant to this idea than finance companies had been. Their pitch to lenders was straightforward enough. Hand over your historical data, who repaid, who defaulted, and Fair Isaac would build a scorecard, a system that weighed actual financial behavior, instead of reputation, instead of gossip, instead of which particular clerk happened to be working the counter that day, instead of which color of federal map happened to have painted your street. The core insight was almost stubbornly simple. Past repayment behavior, measured properly, predicts future repayment behavior better than a stranger's first impression of you ever could. And the resistance they ran into was real, and it lasted for years. Loan officers didn't want to give up their judgment. That judgment was the job. Sizing someone up, trusting your instincts, feeling, rightly or wrongly, like you understood people in a way no spreadsheet ever could. Handing that decision over to a formula felt, to a lot of bankers, like being told your entire professional skill set was worthless. Some flatly refused to even look at the numbers Fair Isaac brought them. So, for the rest of the 1950s, and right on through the 60s and into the 70s, Fair Isaac survived the only way it could, by building bespoke scorecards. One-off systems, custom-built for individual department stores, individual finance companies, not any kind of industry-wide standard. It worked. It made money. It slowly proved, client by client, that the math actually held up, that people it scored as low risk really did default less often. But it stayed a niche tool, tolerated at the edges of an industry that mostly still ran on gut instinct, closed-door judgment calls, and locked files nobody outside the building was ever allowed to see. It would take something bigger than a good sales pitch to force real change here. It would take the law stepping in. By the late 1960s, the sheer unaccountability of the whole credit system had become impossible to ignore. People were being denied loans, denied mortgages, denied jobs, in some cases, based on secret files stuffed with rumor, and more than occasionally, outright discrimination, or simply based on which side of a decades-old federal map they happened to live on. And they had exactly zero legal right to see any of it, let alone challenge it. Congress finally responded in a wave. In 1968, the Fair Housing Act banned housing discrimination outright, taking direct aim at practices like redlining. That same year, the Truth in Lending Act forced lenders to actually disclose their loan terms and real costs in plain, comprehensible language. No more quietly burying the true interest rate somewhere in the fine print. In 1970, the Fair Credit Reporting Act did something even more fundamental. For the very first time, consumers gained the legal right to see their own credit file and to formally dispute whatever was wrong inside it. Then, in 1974, came the Equal Credit Opportunity Act, and this one hits differently once you actually picture what it was correcting. Before ECOA, It was entirely routine, not rare, routine, for a woman applying for credit to be told, flatly, that she needed her husband's signature. Not because she'd defaulted on anything in her life, not because of her income or lack of it, simply because she was a woman, and the system had quietly decided, decades earlier, that she wasn't a full financial person on her own. Picture a divorced woman in 1972 with a steady paycheck and a spotless payment history stretching back years, walking into a bank to apply for a credit card in her own name, and being turned away, told to come back with a man's signature attached, because that was simply how the form worked. It didn't matter what her file said. It mattered what box she checked for sex. ECOA made that illegal banning credit discrimination on the basis of sex, marital status, race, and more. Notice the order of events here, though, because it matters. Transparency and fairness got written into federal law before there was any actual standardized, fair scoring system to run those new rules through. Banks now legally had to show you your file. They legally couldn't discriminate against you on paper. But underneath all that new legal language, they were often still relying on a messy patchwork of local ledgers, inconsistent bureau reports, and whatever internal judgment call an individual loan officer felt like making that day. Interestingly, credit scoring itself ended up playing an unexpected role in defending against these new anti-discrimination rules. When Congress held hearings around the Equal Credit Opportunity Act, the department store chain Montgomery Ward, one of Fair Isaac's clients by then, actually testified in favor of scoring, arguing that a statistical model, unlike a human loan officer, couldn't quietly let any single factor about an applicant tip a decision one way or the other. Whether or not you buy that argument completely, it tells you something. Even lawmakers trying to stamp out discrimination were starting to see a formula as more defensible in a courtroom than a person's private judgment call. The rules had changed. The actual tool to enforce those rules, fairly, consistently, the same way in every city in the country, that still didn't exist. By the early 1980s, Fair Isaac had spent almost 3 decades proving, client by client, that its scorecards worked. What it still didn't have was a single unified score that worked the same way everywhere, for everyone, across every credit bureau in the country at once. That's a genuinely harder problem than it sounds like from the outside. Each of the major bureaus had built its own separate infrastructure, its own separate files, its own separate quirks in exactly how it recorded a person's payment history, their debts, their accounts. Remember, these were the same organizations that had spent decades running totally incompatible, unregulated systems. Some of them descendants of the exact same rumor-based reference books Robert Dunn's network had been printing a century earlier. Getting all 3 of them to agree on one shared model, one scale, one consistent way of weighing a single late payment against a maxed-out credit card, took years of careful partnership building and technical wrangling that almost no ordinary customer ever saw happening behind the scenes. Then, in February 1989, it finally arrived. The first unified consumer-grade FICO score. One 3-digit number, built to mean roughly the same thing, no matter which bureau happened to pull your file that day. No merchant correspondent, no clerk with a pencil, no federal map, just payment history, debt levels, length of credit, types of credit, and recent inquiries, weighed by a formula and compressed into a single score between 300 and 850. It's worth noticing what a strange kind of product this actually was. Fair Isaac wasn't selling lenders a prediction exactly. It was selling them a standard, a common language that a bank in Ohio and a bank in Oregon could both use and trust in the same way, without either of them having to build their own model from scratch or trust a rival's private formula. That's a much harder thing to sell than it sounds, and a much harder thing to displace once it's actually in place. But, and this part tends to get skipped over in the tidier version of this story, the launch wasn't some instant revolution. Adoption was slow, uneven. Old habits don't disappear the moment a better tool shows up on the market. Plenty of lenders kept leaning on their own internal judgment for years afterward, the exact same way loan officers had resisted Fair Isaac's original scorecards back in the 1950s. The score existed now, sure. What it still needed was something powerful enough to force the entire industry to actually adopt it, all at once. That push came fast. By 1991, all three major bureaus, Equifax, TransUnion, and the bureau that would eventually become Experian, were fully calculating and reporting the FICO score on every consumer file they held. Then, in 1995, the real hinge point arrived. Fannie Mae and Freddie Mac, the two giants that back a massive share of American mortgages, required lenders to incorporate FICO scores directly into mortgage underwriting. Once that happened, resistance simply stopped mattering. If you wanted to sell your mortgages into the secondary market, and almost every single lender did, you now had to run your borrowers through this score, no exceptions. Within just a few years, lenders across the country built entire automated underwriting systems around that one number, replacing what used to be a slow, judgment-heavy process. A loan officer reading through paperwork, weighing a stranger's file by hand, with something that could spit out a decision in minutes. Almost overnight, a number that hadn't existed in any standardized form just 6 years earlier became the single most important gatekeeper in American lending. Not your neighbor's opinion of your character. Not a store clerk's private ledger tucked in a drawer. Not the color of a decades-old federal map. A 3-digit number, calculated the same way whether you lived in Ohio or Georgia. Weighing your payment history, how much you currently owed, how long you'd held credit, what kinds of credit you used, and how often you'd gone looking for more of it. And once that number ran everything, mortgages, car loans, credit cards, apartment applications, sometimes even job offers, a new question quietly took its place. Was this actually fairer than the gossip and bias it replaced? Or had we just built a faster, more confident-sounding version of the exact same judgment call? The honest answer is both at once. In the 1990s and 2000s, automated scoring genuinely did open up credit to people the old system would have simply refused to look at. No more depending on whether a clerk liked the look of you or which side of a red-lined street you lived on. But the same wave of automated scoring also fed straight into the subprime mortgage boom of the mid-2000s, where lenders leaned on scores and formulas to justify handing out loans that never should have been approved. One more reminder that a number can create a comfortable illusion of objectivity, even while the underlying decisions stay just as flawed as ever. By 2006, the three big bureaus tried building a rival to FICO's dominance, VantageScore, hoping a little competition might push the system further. It hasn't come close to replacing FICO, but it's a reminder that even the universal score was never quite as settled or as neutral as it liked to present itself. And here's a wrinkle that the story doesn't resolve so neatly. Even today, an estimated 26 million Americans are what the industry bluntly calls credit invisible. No FICO score at all, because they simply don't have enough of the kind of credit history the model needs to work. Often, that's disproportionately people who are young, who are lower income, who pay rent and utility bills every single month without ever missing one. Real, demonstrated financial reliability that For decades, the score had no way of seeing at all. It's the 21st century version of the exact same problem this whole story keeps circling back to. A system that claims to measure trustworthiness, quietly failing to notice the trustworthy people standing right in front of it. Newer efforts to fold in rent payments, phone bills, and other alternative data are an attempt to fix exactly that gap. Proof that even a standard as dominant as FICO's is still, all these decades later, a work in progress, not the finished, neutral machine it's often sold as. Strip away the math, and this was never really a story about a formula. It's a story about who gets to be trusted. And, just as important, about who gets to decide that. For roughly 150 years, that decision sat with correspondents, store clerks, field investigators, and federal map makers, and it carried every single bias those people happened to bring with them into the job. Then, in 1989, we handed that decision over to an algorithm instead, and told ourselves that made it objective. But here's the catch nobody likes to sit with for too long. An algorithm is still built by people, trained on historical data. And that data was shaped by exactly the kind of discrimination the old system ran on for a century and a half. This isn't ancient history either. Right now, today, researchers and regulators are still arguing over bias buried inside modern credit models, over whether medical debt should count against you at all, over whether one single number should really carry this much weight over who gets a home, who gets a car, who gets a second chance at something. Lending has always, at its core, been about trust. We just keep changing our minds about what trust should actually look like, and about who gets to define it for the rest of us. Go back to the very start of this story for a second. Lewis Tappan's correspondents were asking, is he a man of fair character? The FICO score asks something that sounds completely different. Payment history, utilization, length of credit. But underneath it, it's really asking the same question in a new dialect. Can we trust this person with our money? We just traded a neighbor's whispered opinion for 100 and some data points and a formula nobody outside the company gets to see in full. That might genuinely be an improvement. In a lot of ways, it clearly is. But it's worth remembering that a black box is still a box. And the people building it, testing it, deciding what counts and what doesn't, are still just people, with all the blind spots people carry with them. Next time that notification pops up on your phone, your score up 3 points, down 5 points, whatever it says today, it might be worth remembering everything that number replaced. The correspondence, the clerks, the maps, all of it, boiled down to 3 digits, still deciding, in the space of a blink, whether you're the kind of person this country is willing to trust. If you liked this one, you know what to do. Subscribe, and I'll see you in the next one.